What is up, guys? You may or may not have seen me before. My name is Realite Realm, and today I'm bringing y'all this video. It is called The Truth of Liquidity Cascades, and I have an asterisk on it because I'm not just talking about liquidity cascades, but I'm also going to be talking about just in general market crashes. So that's why I have that asterisk on there. I encourage y'all to buckle up because I gotta make this video and I might go through this a bit quickly because it is late in the day for me. Well, it's not even day, it's night. And so I wanna get this done for tomorrow. Anyway, let's continue. On my screen it lags out, so if you see me going back and forth slides, it's because it's lagging out on my screen. So liquidity cascades or just crashes. Here I have a compilation or just a gallery of photos of gathered from the futures NASDAQ market. You can see here, this is the October 10th crash from 2025. This is the tariff tantrum crash of 2025, so last year. We have some other crashes, like this one is the one from 1987, I'm pretty sure. Then we have the 2000 crash and the 2008 crash or 2007. This one's the 2020 COVID crash. And all of these are either just crashes or they have some sort of liquidity strain in the market. Or a liquidity cascade occurs. So what even is a liquidity cascade? Well, a liquidity cascade is when a market event forces leveraged positions to liquidate and or trigger stop loss orders, which then causes a bunch of selling. This is forced selling, and that dries up the liquidity in the market because it absorbs, quote unquote, all of the buy orders or all of the market buy that happens. And then the forced selling causes more price drops, and as the price is dropping and accelerating, more stop orders are hit, which causes even more selling. And since price is moving so aggressively, market makers have like a threshold, and so they pull away from trading since their thresholds are overmet, which depletes even more liquidity in the marketplace, and it's just kind of like a domino effect that happens. But this is where we talk about what actually happens in the marketplace and what's the reality, because everything I just showed you here, or most of what I just showed you here, is actually straight up lies. They're straight up lies. All of this is lies, and I'm going to show you what actually is what causes these prices to drop and what is actually happening in the background that you guys don't see or will ever hear about. Well, you'll hear from me and maybe some other people. Some people I would say like ICT. You can search them up on YouTube. Inner Circle Trader. But anyway, so this is what we have, our market right here, right? We call it like a free market. That is actually false. This is not a free market at all. And it is actually all controlled by one entity. Everything in the market is controlled by one entity. None of it is random. Even the crashes. The crashes are not random. They're all planned. And the entity it's controlled by is called smart money. And they control it via the algorithm or their AI, their artificial intelligence. They can also control the market manually, and that's what they used to control the markets in the past. But now that since technology has evolved, they can just do it algorithmically and automatically. It's automated. And the markets, as I said before, Everything is controlled about them, but the markets are 100% rigged. All of the markets are rigged. Every market is rigged. All of them are 100% rigged. Just guaranteed, 100%. They're 100% rigged. They're 100% controlled. Every aspect of the market is controlled. Literally everything. Even the crashes that seem quote-unquote random or sudden, the black swans that happen, those are controlled. They're 100% controlled. They're pre-planned. It's already planned. It's like it's already planned beforehand. It's already dictated. They're 100% manipulated. The markets are 100% predetermined. Okay? The future is already set. Like you can see the future. If you can read the market and the algorithm, you know what the future is. You know what's coming. The markets are ran by the algorithm or the AI, and the markets are sometimes manually intervened. What does that mean? It means that smart money can come in and manually intervene with the algorithm because they're the ones that created it, or at least own the algorithm, so they can do whatever they want with it manually. They can manually adjust it. But it's the same thing anyway. They're not going to change like the rules of how it works, because why would they? They already have their own rules that they created for themselves that most people don't know exists. Anyway, now we're going to point out the actual lies and truths of what I showed in my previous slide. So, the market event forces leverage positions to liquidate. That does happen. That is truthful. Are stop loss triggered? Yes, they're triggered. The forced selling occurs, which dries up liquidity. Does this dry up the liquidity? Yes. The forced selling causes more prices to drop. No, that's not real. That's not true. Prices don't drop because of selling, and prices don't go up because of buying. There's no buying or selling pressure. That does not exist. The only reason price moves is because there is a price engine, and we all know this. We all know this. And if you didn't know this before, then you're learning about it now. But if you're seeing this video, you're most likely know about it or have heard about all of this. But hey, if you haven't, this is like you should know about this. So I'm showing you here. So anyways, the forced selling does not cause prices to drop. It's smart money with their algorithm causing or making the price drop, which causes the forced selling, but the forced selling is not causing the price to drop. It's smart money dropping the price, which causes the forced selling to happen. So then more stop orders are hit, which causes more selling. That's true. Now it says here the market makers pull away. So yes, they do pull away. But the red herring here is that whenever people online or just anywhere refer to market makers, they're not actually market makers. The people that you see like in the New York Stock Exchange, all of these exchanges, and they refer to them as market makers, those are actually not the real market makers. The real market makers are smart money. Those are the real market makers because they literally are the market. They literally make the market. They literally create the market with the algorithm. The other people you see refer to themselves as market makers are not actually the market makers. Those are the market dealers, and they don't get to choose where price goes or how price is created. They still have to play within the rules of where price is delivered by the algorithm owned by smart money. So the real market makers you will never see publicly. You'll never know anything about them. You will never see or hear about their names. You'll never know how they look like. Those are the real market makers. Okay? The people you hear about that are said to be market makers, those are not market makers, they're market dealers. Okay, they're different. So nobody or most people don't know who the real market makers are. They only know about the fake ones, which are the market dealers. But since people don't know about the real market makers, they think that the market dealers are the market makers. And there could also be um, the justification that the real market makers created that discrepancy so people don't know that they exist, and they attribute the market dealers as market makers. Anyway, let's move on. So this is actually what this is what people or people online, educators would show you, is how a liquidity cascade actually works. So here we have the market event, right? Which, just as an example, I'm going to say that it's the reverse yen carry trade. Now, if you haven't heard about the reverse yen carry trade, I'm thinking of making a video about it. But you can search up what that is. It's basically like when people use the yen, they borrow yen, and they invest it in markets, and whenever something happens to the yen or like the Japanese economy, they have to pull out, which causes like aggressive price runs or crashes, supposedly. But we know, and I'm going to explain how that's not actually what causes the price to drop, and how it fits with what I'm saying, that the market makers, smart money, the algorithm, it's the same thing. They're the ones that actually cause all of this. So, anyways, this is like the timeline of events of how people think liquidity cascades work. So some market event happens, then the price crashes, right? And then after price crashes, over leveraged longs are liquidated and their stop losses are triggered, and this causes even more selling. So the liquidations and stops being hit induce more selling, absorbing all buy orders, which dries up the liquidity. And then the selling supposedly causes price to continue crashing, and then it keeps accelerating, and then that's when the domino effect kind of happens. So as prices keep accelerating lower, more longs are liquidated and more stop losses are triggered, which even causes even more selling as prices continue to drop. And that would be like the retail dumb money perspective of how this works, and they believe that this is how a liquidity cascade or market crash functions in the marketplace, when none of it is true. And I'm about to show you how it actually works. This is how it actually works. It's actually very simple. So imagine you are a smart money entity. You have big pockets. You have, I mean, billions. I would say billions of dollars, but maybe even more. And you know where the market is going because you created your own algorithm, and so you just know where it's gonna go. Literally, there is no losing. You don't lose if you're a smart money entity. You just don't lose. You are literally the market. You're always winning. No matter what, you're always winning. Just imagine it like that. It's very simple. They're always winning. That's just how it is. Okay. So you're a smart money entity, and you're accumulating short positions as price is going up, based on their algorithm setting up an aggressive crash for later in the future, and they know that. Or they could also manually guide the algorithm because, as I said, they can manually intervene and adjust things. But obviously, they can't just cause the price to go down without any type of like excuse for everybody else, the public, retail, to blame, to put the blame at, because then it'd be super suspicious. It'd be too suspicious if out of nowhere prices drop and there's no like justification for it. It'd be suspicious. Everybody would wake up to the fact that the markets are actually in fact 100% rigged and controlled and manipulated. And so what smart money does, and this is what people don't even know, and I'm sure nobody has ever heard this before, but I'm going to say it here first. I think I'm the first. I don't know. I believe that smart money is the same people that control talking heads around the world, politicians, anything in the world, in the real world. They have their hands and they control everything in the real world. They're the powers that be. And so what they do is they contact and they force and they tell their politicians, their mannequins, their talking heads, whoever, whatever it is, news articles, the media, social media, they go on there and they manufacture, okay, they manufacture an external event to use as a smokescreen or a scapegoat for them. So that way that they can short the markets, cause price to drop, and nobody will suspect that it's a external entity that's causing all of that because they've created a smokescreen. You know, maybe they tell a politician to do something specific in policy change or something like that, or they tell the media to release a specific article that causes panic, and people think that that the media panic is what caused prices to drop. You know, something like that. And then once they do that and they can time it, the algorithm will reprice lower aggressively, forcing everybody else to sell. But smart money has already accumulated short positions right at the very top, at right about as when they know that the price is going to drop. And then as price is dropping, well, if you're smart money, if you've accumulated millions or billions of dollars of short positions, well, how do you get out of a short position? Well, you need to take profit, right? But if you entered short, you're selling, right? You're entering into a trade by selling. So the way to get out of a short trade is by buying it back. So if you're buying it back, you need sellers, right? Because who are you going to buy from? You still need people to buy from. So you need somebody to sell it to you. And so that's exactly what they do. They engineer these external events and sentiments in the market and in real life, so that way everybody is going long in the marketplace, retail is going long, and they know this because they know how to manipulate people. They're experts at it. They're experts at psychology. And they create all of these long positions that they're going to be counterparty to, these retail long positions. And obviously everybody's going to have a stop loss, right? Everybody's going to place their stop loss below previous old lows. And so whenever smart money is ready, or I should say whenever the algorithm is ready to deliver price lower, that's when all the positions that are long are going to get liquidated and they're forced to sell. But who are they selling to? They're selling to smart money. Do you get it? Smart money is buying it back from the sellers that are forced. Like they're forced to sell. They have no choice because of the random, quote unquote, random repricing aggressively lower. And so that's how smart money is making their profits. They're making their profits that way. Easily. Anyways, let's go to the next step. Since everyone is forced to sell, who are they selling to? Smart money. Smart money pair their take profit exits, which would be buying back since they are shorts, to the sellers they've created for themselves to use as exit liquidity. And then everyone, which are the retail traders or just the public, dumb money, are putting the blame on the scapegoat that smart money has created. And in that way, smart money is never known. Boom, there's a check mark. So now what I'm going to do is I'm going to show you an example on TradingView. So here we have the market in 2024 going into 2025. I have it on replay. And I want you to imagine your smart money. What do we have here? Down here we have sell stops. How do I know that? How do I know that there's stop losses down here that are ready to sell? Because people are trained to put their stop losses right below old lows, especially if they're going long. And so if you're long in this market, if you're going long here, then obviously where would your stop loss be? Well, you'd put it at this low. If you bought up here, you'd put it somewhere here. If you bought up here, because maybe you thought this was a support area, you bought here, you're targeting way higher, you put your stop loss here, right? And so what smart money does is they target those. They target those stop losses. And since they know, this changes into a different color. Let's make that gray, and then this like a blue. So this is the smart money position. Smart money, these red arrows are smart money accumulating short positions. So every time a high is created, they're selling into that. And then right here, you can see is where they sell a bunch of their, or they get most of their shorts there, because that's when price is literally about to drop. So boom, the enter right there. Honestly, they might not even use a stop, to be honest, because like if they just know exactly where it's gonna turn, there's no reason to have a stop. And so the algorithm here is going to reprice lower. But first, before it reprices lower, they have to make sure that they cover their tracks and they call up someone. It could be, maybe someone like Trump, to create a scenario for them to justify the market dropping aggressively lower, like tariffs. And everybody is forced to sell. All of their stop losses are triggered. And since they're forced to sell, well, smart money has shorted up here, and they're taking profits up here by buying it back from the sellers they've created and manipulated into existing in the first place. And so as price keeps dropping aggressively, not from a freaking crash that just happens because of selling, but because this is just how the algorithm delivers price, it just keeps dropping, and smart money just keeps taking their profits. There you go. And then down here, this would look like as a support zone for retail. So obviously, this is going to have a massive amount of orders resting down there. And then that's most likely where smart money takes the majority off of their positions there, or like close or collapse their positions, their short positions, from all the retail traders that had their stop losses down there. Right? And boom, that's how it works. Or, they might not have a stop loss, but I can guarantee you that if somebody saw this price crash, they would probably chicken out and be scared and have fear, which is exactly the point of the freaking crash, is to cause and induce fear, so that way they're choosing to sell anyway without the stop loss, and then smart money is buying it back from the sellers as their take profits, because they shorted up here and accumulated all their short positions. And that's exactly how it works. That's how the markets work, and that's the reality of what actually happens in the marketplace. And it's all 100% controlled, and selling pressure does not exist. Is not what causes price to go down. So now the main points from this presentation that you should take is that buying and selling pressure does not exist and is not what causes the markets to go up or down. The algorithm is the price engine which actually creates or delivers price. So whatever price you see on your screen, that is created by or delivered by an algorithm and price engine. It doesn't matter how many people are buying or selling. It does not matter. You can have the whole world buying a market. It won't cause the market to continue to go up. That's just not how it works. The algorithm will do whatever it's going to do. The next point is that the market makers you hear about are actually market dealers, and the real market makers are smart money, and you'll never see them or know their names. Smart money is the same entity that controls the world and its governments. And then this last point is, I think, like the most major point, is that black swans or sudden crashes don't happen because of external real life events. More so, real life events happen because of black swans. So if smart money is creating the black swan in the marketplace or the algorithm, then smart money needs a reason to justify that in the marketplace, so more people can keep coming in the marketplace and thinking that this is all just random, and this just happens, and people just accept it as something normal, because then, you know, smart money needs the liquidity, of course. Oh, I was gonna say, if you can read the market well, which if you understand the algorithm, it's pretty easy to predict the future. You can predict what's gonna happen in real life. That's how it works. If you know what the market is doing and what it's going to do in the future, you can predict what real life event is going to happen to justify that. Why? Because smart money is the ones creating the real life events to justify the market. But it's not really like the real life event does not cause something in the market to happen. It's smart money knowing what the algorithm is going to do in the market and them needing to create a real life event to justify that. So that way more dumb people come into the marketplace, dumb money, pour their money into it, and that's, you know, that's just the trap that we all get into. But yeah, anyways, I hope you guys learned something there. Thank you for watching, and my name was Real Detail Realm, and you may or may not see me after.